Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for September 2021. Let's take a look at key highlights of August 2021. India's GDP grew at 20% year-on-year in first quarter of financial year 2022, primarily due to low base effect. However, on a 2-year CAGR basis, it has contracted by 4.7%. While contributions from manufacturing and services have bounced back, the growth needs to sustain for the economy to get back on track. Though the monthly GST collections have been more than Rs 1 lakh crore for almost all the months in calendar year 21, its contribution to overall growth in tax revenues is not significant. The credit offtake is still at subdued levels in a low interest rate regime, which shows that recovery is still in the nascent stage and has a long way to go. In addition to it, the employment scenario in India, which is not showing any signs of improvement, indicate that it will take a bit longer for the economy to get back on the track. However, increased pace of vaccinations and low number of COVID cases on sustainable basis inspire hope of quicker return to normalcy. At the global level, in Jackson Hole meeting concluded in August end, Fed indicated that they are likely to begin tapering of liquidity before the end of the year. Meanwhile, Chinese economy has lost its momentum in recent months. Cut down in infrastructure spending, contraction in investments, and recent regulatory developments around internet and tech companies played a critical role in reinforcing negative sentiments. Equity view. FII interest in Indian equity markets has been subdued in the last 3 to 4 months. However, it is well compensated by domestic retail equity investors. Flagship Nifty 50 index continued to attain new highs in the month of August, while mid-cap and small-cap indices generated comparatively subdued returns. Our decision taken in the last month to reduce allocation to mid- and small-cap universe proved to be well-timed. Fundamental elements like earnings growth and profitability have shown signs of recovery, although more visibility into financial year 22 and financial year 23 numbers is required. Calendar year 21 is turning out to be one of the best years for primary markets. Demand has been aided by ample capital and liquidity in the system. In the current market scenario, we change our stance from marginal overweight to neutral. We continue to maintain neutral stance on mid and small cap exposures as per respective risk profiles. Buoyant earnings of Indian corporates in Q1 financial year 22 and increase in pace of vaccinations lend reasons to be hopeful for return of normalcy. However, supply bottlenecks, possibility of liquidity tapering, sluggish consumer demand, and chances of a third wave of COVID may create headwinds going further. Fixed income view. RBI's accommodative stance continues while providing ample liquidity in the system. RBI have stated that their support will remain as long as needed for economic recovery on a durable basis. CPI inflation moderated to 5.6%, which is approximately 40 basis points lower than expectations, mainly because of softening of food inflation by 90 basis points, although core inflation remains sticky at 5.9%. Yields at the longer end of the curve remain around 6.15% to 6.25% levels, while short-term yields continue to remain low due to lower policy rate and high liquidity in the system. That has prompted the sovereign yield curve steepness to remain range-bound. Investment opportunities in high-quality credit have significantly diminished. High-yield credit can be considered subject to appropriate due diligence. The credit spreads can be expected to cool off as systemic risks will decrease with recovery in economy. Stability in tax collections indicate reduced possibility of fiscal slippage. However, sensitivity of the yield curve to geopolitical risk cannot be ruled out. While RBI is expected to continue with accommodative stance, the yield offered by fixed income instruments are expected to remain soft. Dislocations in spreads still persist in high-yield credit, which may be opportunistically used. Core allocation to high-quality credit with diversification across investable credit spectrum in yield-oriented HTM solutions is advisable.